economic landscape. Stephen Miran has served as chair of the Council of Economic Advisors since January 2025. He has been on leave since September following his appointment as a member of the Federal Reserve Board's Board of Governors. Roger Ferguson, no stranger to Cambridge, served as the 17th Vice Chairman of the Federal Reserve from 1999 to 2006. He was previously the Pembroke Visiting Professor of International Finance here at Cambridge Judge Business School, and is now on our advisory board. Our moderator today is Camilla Moades, Associate Professor in Economics and Policy, Director of the Global EMBA, and Specialist in Social Media. Over to you.
Thank you. Thank you so much, Gishan. Thank you so much. Thank you, everybody, for joining us this evening. You won't be surprised to know that we were initially in a room which was just downstairs, and then when sign-up started, it was sold out very quickly, so we had to move to a bigger room. And as is probably, as you can see, I apologize for those of you standing, but clearly we need a bigger building, Dean. I don't know where there you are. We need a bigger building with a bigger lecture theater. So thank you so much for joining us. Just to let you know, those of you who don't know the format, what we're going to do is I'm going to try to ask a few questions, about 20 minutes, 25 minutes. And then I'm going to leave plenty of time for you to ask questions. And I hope you're going to ask some very good questions. The best questions, as is traditional, will win a book. Now, I don't agree with Ken Rogoff, but this was the book that was the one that I could get the quickest today. So you'll get Ken Rogoff's book and signed by our panelists. So let me just. I'm with you, Steve. I'm with you. Yeah. Ken, I hope you're not watching. Thank you. And for those of you online, you have an option to ask questions online. I hope to get it on my laptop, and I hope to be able to see your questions, and we'll try to do those too. But we will start in the room. Okay. So you've done the introduction, and we can just jump straight in. I was going to ask a soft question first, but I'm going to jump straight in and say, what is your view, Steve, about the state of the U.S. economy?
So first of all, thank you.
Easy question.
Thank you for that introduction, and thank you all for being here and for coming out to chat with us. Look, I think that at the Federal Reserve, obviously, we've been tasked with achieving two mandates: stable prices and maximum employment. And so when we think about the economy and the evolution of the economy, that's what we think about. As I think about inflation, I tend to think, as I've sort of been saying, that I think it's going to come down. Part of the reason why I think it's going to come down is because I think that we're measuring things that aren't indicative of where real underlying inflation is. And so there's a couple of items in particular that I think give a bit of a distorted lens in the way that inflation works in the United States. One of them is the way that we measure housing inflation. So housing is, of course, most people's biggest expense, and it, as a result, has the biggest weight in the index. But the way that we measure that is such that, we measure inflation when leases reset. And, if market rents are running at about 1% as they are now, as they have been in the United States for a couple of years, people only really experience that when their leases reset. And their leases may reset every 6 months, 12 months, 2 years, depending on who you are and where you live. And as a result, the way that we measure inflation lags behind where the market is by a significant amount of time. And measured shelter inflation is running closer to 3.5 than it is to 1. As a result of that, I think that the inflation that we're measuring is actually quite backward looking. And there's a variety of reasons for thinking why the way that we measure shelter inflation will converge down to where the market level is in the relatively near term. Part of it has to do with this catch up finally seeming to be, to me, like it's about done, and that measured inflation should catch down to where market rents are. And part of it is also due, I think, to sort of changing population dynamics. We had the biggest immigration driven population growth shock in the United States in our lifetimes. And we experienced 30 years worth of changes to the population growth rate in only 3 years in both directions. It then did a very rapid 180 and reverted back down very quickly. And this is something else that will help, I think, bring shelter inflation down. My view is one that shelter is the most important part of the index. It's also one that's very backward looking, and one that I expect to sort of come down materially. Another part of sort of thinking about inflation in the United States is that the way that we measure inflation also includes a number of what are called non-market prices. And so it has to do with the fact that the way that inflation is particularly measured in the personal consumption expenditure index, which is what the Fed targets, tries to count what people consume and not necessarily what they spend money on. And there's a lot of elements of that that are what I think of as being phantom inflation. And so, for example, if you look at the way the financial services are captured in the PC inflation index, they're captured. One of the things that goes into that is portfolio management services. That tends to be counted as management fees that you pay on your assets that are being managed. But when markets move higher because of appreciation, you pay more money because the base goes up. The management fee can be probably fixed, but if the amount of assets you have goes up, then you're paying more in fees. That gets recorded as a price increase and not a quantity increase in the way that we measure inflation. And yet it's the type of thing that, taken literally, monetary policy would respond to with higher rates just because the stock market went up. That doesn't make a lot of sense. And so I think there's some mismeasurement in there as well. When you sort of take out these elements, when you take out things like shelter, when you take out, or you look forward to it coming down, or you take out this phantom inflation in the form of portfolio management services, inflation in my mind is running a lot closer to 2%. Inflation that people are really experiencing. If you look at market-based measures of PC inflation, it's running around 2.3, 2.4, depending on how you slice it exactly. With respect to the economy,
Sounds like Fed policy is too restrictive.
I think Fed policy is too restrictive. I think that policy is being made on a backward-looking basis. In the case of shelter pumping up the index in a way that we shouldn't think of it doing. Like, shelter inflation is high because home prices and rents went up in 2022. Right? We shouldn't be making policy based on what happened 3 years ago. That is so backward looking. And I think a recipe for getting policy wrong. Policy should be forward looking, not this backward looking. And also, we're making policy because imputed prices that I think are phantom inflation, things like the stock market moved higher, and that gets recorded as a price increase. I think that's kind of nutty. So we should be looking for signals from prices that there's a supply-demand imbalance. And those are not indicative of a supply-demand imbalance at current. They're indicative of other factors that are driving things. As to the state of economic growth, on the flippant answer is I wish I could tell you because we have no data. Hopefully that gets resolved soon. But looking forward,
data is very important, by the way.
Data is important. I hope some of you will go off and create organizations that give us more data. We want more data. But going forward, I think it's incumbent upon us to get monetary policy right, to get it out of such a restrictive state that would eliminate some of the downside risks to the economy. As a result of that, I see a number of positive shocks that can hit the economy going forward. Things like the removal of red tape and regulations. Things like the removal of uncertainty from trade from the first half of the year. There are things that I sort of can see as sort of driving some positive growth in the economy going forward. However, it remains the case that I think that monetary policy is too restrictive, and it would be nice to be able to sort of have a better sense of the state of the economy with more data. But I should give Roger a chance to talk to
Roger. I Googled Roger to make sure I got the correct data. I found it on Wikipedia. Roger is the longest serving vice chair of the Fed since the first oil shock, 1973. So just
that is a fact.
it is a fact. It is a fact. What do you think? Is Fed policy too restrictive?
So look, that is, to be fair, that's the essence of the debate, right? We saw in the last FOMC something that's highly unusual, which is Governor Miran dissented in one direction, one of the other voting members dissented in the other. And so you put your finger on exactly the dilemma the Fed faces. There are strong arguments that said, policy is too restrictive. There are some strong arguments that said, wait a minute, financial conditions look like they're actually, quite robust. The equity markets continue to rally, housing market continues to rally in spite of the challenges. There are folks who would criticize the governor's analysis in the sense of that may be what occurs, but until it occurs, are we prepared to actually take the bet? And so I think the dilemma for the Fed right now is measured inflation is certainly running well above the 2% target. One of the things the governor didn't mention that I know has been on some people's minds as supporting the notion of reducing rates is the labor market appears to be a little soft, but there are questions about that. And so I think the challenge for the Fed right now is, and Chair Powell said it very clearly, the next step is far from certain. In his most recent press conference, he did something pretty unusual, which was not address this vote, but address the December meeting and made it quite clear that it's not a foregone conclusion that, the Governor Miran's theory will hold. So look, and it's all because of two challenges. One is, I believe, the Fed is very cautious about the outlook, having, I would imagine, maybe been a little wrong about, the pickup inflation, how long that would last. Secondly, they're very cautious in the outlook because of one of the things that the governor talked about, which is in the labor market, the nature of immigration changing quite dramatically has also made that market hard to read. So I think what we've got now is what you absolutely see and have seen for at least 2 or 3 meetings, which is a tightly divided Fed trying to sort out exactly some of the points that the governor addressed. Fortunately, he's got a very strong analytical framework that some people will agree with and some won't. Others have equally strong frameworks. And I do believe that this Fed will move very, very cautiously until there's a bit more evidence in one direction or the other, and that may take some time to unfold.
Brilliant.
I'm not sure that was brilliant, but it was accurate.
I thought it was very good. I thought you both did very well. No, I'm
Thank
just
you.
kidding.
So we'll get the book with the best answer.
Exactly. Let me ask you another question. There's a lot of talk, a lot of narratives around de-dollarization. By the way, those of my students who are there's an assessment coming up on this. So what are your thoughts? What are your views around that?
Around
De-dollarization.
Oh, well, I mean, I think that the international role of the dollar remains extremely strong. I don't think that there's any real evidence that indicates any change to that. The dollar remains at the heart of global finance, at the heart of global trade, and is an enormous asset to the United States.
Roger,
I agree with that completely. As one thinks about it, when one reserve currency leaves the scene when another steps onto the scene, right? And so here we are in the UK, which for a long time had the reserve currency, and then, after the Second World War, the U.S., or maybe before, the U.S. dollar became the reserve currency. I think the reserve currency's got to be associated with a number of things that the U.S. brings and no other country brings to the same degree. Deep and liquid markets, rule of law, et cetera, et cetera, et cetera. And so I'm very much with the government. I don't see a replacement for the U.S. dollar as reserve currency at any time that matters. Having said that, we see at the margins, a slight degradation, but it's only at the margin. So folks who wish to question what we have just said would say, well, yes, but look at the international reserves, which at some point were 60, 70% dollars, and now it's down to, slightly above 50 or some number of that sort. So, at the margin, sure, other currencies are starting to become relevant. But I would say there's only one reserve currency, at a time. And I believe as far as the eye can see and as far as we can imagine, the US dollar is likely to be unchallenged in that regard.
Okay, so let me read something in a speech maybe many of you didn't listen to. It's on the Fed website. So the America's capital markets are the world's deepest, helping to support economic growth, fund new ideas, and allocate capital efficiently. However, our financial infrastructure, not unlike our physical infrastructure, could use a reboot. Stablecoins may well lead the way on this front. So the question to you is, can stablecoins reshape the global financial system?
Yeah, so that's from a speech that I gave last week about stablecoins, or rather about the implications of stablecoins for monetary policy. Let me be clear. Like, I don't hold myself.
Many people probably haven't. So if you get just the essence of the speech, perhaps for.
Yeah, sure. So I argued two things. First, I argued that stablecoins, in the United States under the Genius Act, they don't offer yield. And they don't offer deposit insurance. And if they don't offer yield, they don't offer deposit insurance, but they are backed by high quality liquid collateral like Treasury securities and bank, Fed reserves, bank reserves. Then they're a high quality savings and transaction instrument, but they don't offer yield. And so as a result, I don't see a huge amount of the growth in the future in stablecoins coming from sources of savings that already have access to instruments that give them yield. Here in the UK, there's no barriers to obtaining dollar savings. If anybody in this audience in the UK wants to own a treasury bill, you can own a treasury bill that will offer you yield. If you want to have deposits in a bank that will offer you deposit insurance, you can do so. And so as a result, there's little incentive for a place like the UK to sort of put a ton of money into stablecoins. However, if you're in a country where you don't have access to large amounts, if you don't have access to dollar savings instruments like treasury bills or money market funds or bank accounts or whatever it is, stablecoins help allow you to access those vehicles in a way that you might not otherwise be able to, whether it's because of capital controls or the lack of local banking services. And so therefore, for that reason, I expected most of the uptake in stablecoin usage to come from people for whom there's no real alternative. Everyone in the UK and the EU can already access all the dollar savings they want to, right? There's no barrier to that. It's the places in the world where they can't do that suddenly there's a new option, new technological solution that didn't exist before. And if you sort of think about, if you think about, like, so I'm from New York, right? And, in New York, years ago, there was a taxi cab monopoly, right? And so the number of taxi cab medallions was limited. And so, so those medallions cost $1 million or whatever. And it was basically a monopoly, which elevated the price of taxi service. Then comes along an innovative, rideshare app that allows you to basically get around the taxi medallion. Now, it was always the case that like I could have paid a friend or whatever to drive me around, or asked a friend of a friend, I need to hire someone to give me a ride or something. That was always the case in violation of the monopoly. But it was the technological solution that allowed the large scale adoption of the practice of evading the taxi monopoly, which ultimately collapsed because of the rideshare apps. Now, fast forward, and sort of the regulations then restricted supply anyway. But that was a decision of the New York State and city to do so. But stablecoins are similarly, they provide a technological means of accessing dollar instruments in places that didn't previously have that means. And so therefore, I expected most of the growth to come from those geographies and not a place like the UK. Now, that's point number one. Point number two is I'm not really well equipped to forecast stablecoin uptake. I don't know exactly how much growth there will be, but if I take other people's estimates of those numbers seriously, then those imply new demand for US savings vehicles, whether it's so every time you buy a stablecoin, the stablecoin issuer has to back that with collateral. So they have to back it with a treasury bill or a treasury note or a deposit or repo or some other saving vehicle that's denominated in dollars. So therefore, there's a big flow of money into dollar savings instruments. Now, if you take those 2 points together, then you can sort of take the forecast for stablecoin growth and sort of imply, the growth in demand for dollar savings assets. And the way that I think is appropriate to think about this is to put it in the context of what former Fed Chairman Ben Bernanke called the global savings glut about 25 years ago, in which global central banks recycled their export surpluses into dollar reserves. And that pushed interest rates in the United States down. And so what I do is just put those numbers in that context. And I say, if you just look at the estimates, and I take them seriously. And again, I don't know, I'm not a stablecoin growth forecaster, but if I take other people's growth estimates, it would be, I think, about 30% the size of the original global savings glut. And if you take like the high end of the estimates, it would be about 60% the size of the original global savings glut. Now, that's not 100% of the original global savings glut, but the original savings glut was hundreds of basis points of lower treasury yields in the United States. So even if you're taking 30 or 60% of that, it still has material implications for monetary policy and how we should be setting policy.
Roger, you?
So I agree broadly with 2 or 3 points, and I would make a couple of slight amendments or adjustments. So I strongly agree with the notion that, dollar-backed stablecoins probably mainly have a place where the citizens both have access to technology and also don't trust their local currency for one reason or another. And so it's a technical version of dollarization in places where inflation is rampant or there's some other weakness in the banking system, which is sort of an implication of what the governor had to say. I think in countries like the US, the UK, et cetera, what might be interesting about stablecoins is the technology angle to it. But the question really will become, is there a place where you can use the stablecoin dollar backed as a medium of exchange, right? Because the theory of the stablecoin being stable is that it is a store of value because it should trade at par, call it the dollar. So what makes it different is it's purely electronic And perhaps there are, call it a world of e-commerce, in which the stablecoin becomes the medium of exchange. Because if you think about the way e-commerce works now, effectively, either you pay for it with a coin, stable coin might be the way, or you pay for it with something like a credit card or a debit card, which then takes you back into more of the physical world, so to speak. So I think the governor is basically right, but I would also say there are maybe use cases for stable coins in parts of the economy that are really sort of native virtual, even in places like the UK or the US, et cetera. I strongly agree with you. It's hard to figure out what the use case is actually going to be. It's impossible to speculate. I'm not going to jump into, well, is this actually going to be 20 or 30% of the current global savings glut? I think it's really hard for me to quite.
That's speculative, and that's I just said if you take their forecast seriously.
I'm not suggesting you are endorsing it. I'm saying I'm with you in that. That may be the number. I would put little weight on any forecast until we actually see how this unfolds.
To be clear, I'm not advocating for making policy now based on that. This is a long-term.
I hear you. I hear you, brother. I'm with you.
If you were, I'm just kidding.
But you should understand I invited the governor to come. He's my guest, so we are aligned on the major important policy issues.
Okay.
But this pushes back against like the dollarization hype. I think will be this is one of the things that may be pushing strongly against that narrative, and
that's why I set you up. I said de-dollarization, and then
absolutely.
Brilliant. Let me ask you. Actually, are you thinking of questions, by the way? How many questions do we have already? Oh, that's enough. That's not enough. Okay, so let me ask one last question, and then maybe some people here don't understand the workings of the Fed. So I was just thinking, how do you, as a Fed, evaluate risks? How do you evaluate risk, and maybe these big risks that we or threats that we are observing in the global economy?
Sure. So there's I mean, I hate to sort of be trite, but there's the known knowns, the known unknowns, the unknown unknowns, right? And I think a lot of it sort of is trying to think about shocks that have hit the economy, and are we thinking about shocks the right way? And so, for example, I think that most people in the United States, when they discuss immigration, they're thinking primarily of the labor market, right? For me, as a monetary policymaker, that's not how I think about it, because I think of immigration as largely moving supply and demand by roughly the same amounts when it comes to labor. And so if you have an additional person in the economy, they're working more, that's additional labor supply, but they're also consuming goods and services. And so they're creating additional labor demand. And monetary policy responds to gaps. It responds to output gaps. Monetary policy works through balancing supply and demand. And if supply and demand are moving by roughly the same amount, there's not necessarily anything for monetary policy to do. Now, that's not true. So I think generally in most markets, if you have a population growth shock, it's moving supply and demand by similar amounts because people consume and people work. But that's not true in every market. And I think that the market in which it's the most prominently not true is housing. And the reason is that the supply of housing doesn't adjust. The supply of housing is pretty sticky in the long run. And as anybody who's been through, an intro econ class knows, if you draw a roughly vertical supply curve, then all shocks have incidence purely on prices. And so I think that the contribution of something like immigration to shelter inflation has been substantial in the past, and the reversal of that shock in the United States is also substantial to oncoming disinflation that I expect us to have, that is already materializing in market rental data. Although, as I said before, it will be some time until that materializes in the measured inflation data, but you're already starting to see that happen. So for me, it's sort of trying to identify what are the big shocks that have hit the economy, and are we thinking about them in the wrong way? And then are we thinking about them in the right way? And then also, what are the shocks that we can sort of see coming down the road? And so, for example, we have, yes, a lot of the trade uncertainty in the United States has resolved with the progress of negotiations and trade deals. However, the U.S.-China trade relationship bubbles up periodically with uncertainty, right? That's another element of sort of looking down the road. What are risks? What are uncertainty? What are uncertainties? But I guess to answer your question, you want to be thinking about what are the risks to inflation, what are the risks to employment, are they on the upside or on the downside? How are what are you not thinking of that that could materialize. For me, again, and I'm sorry for returning to this for the millionth time, but so much of my inflation view is predicated on the fact that the measured shelter inflation is extremely backward looking, and I expect a lot of shelter disinflation in the future. And so that overwhelms all, because it's such an important part of the index, it overwhelms elevated inflation that you might see in other parts of the index. So for me, where would I be wrong is if my shelter expectations don't come up, don't come true. So I'm looking for, and I spent most of my career in financial markets before getting involved in policy. So I'm always looking for where could I be wrong. And I've identified this as, likely if I'm going to be wrong, how am I going to be wrong? And it's probably this, right? So I'm very focused on observing what's happening in housing markets and rents. And thus far, I don't see anything that tells me that I'm wrong in the United States. I don't know about housing markets here, but
I love housing, but I'm going to push you on something.
Please.
As most of you know, it's COP30 going on. So I'm just wondering, what would you think of climate or weather shocks? So let me give you an example. So NOAA's estimation, those of you who don't know, there's these natural disasters that happen, some of them due to climate change, some of them happen naturally, cost the US economy a lot. Brick and mortar cost of, I think 2017 was close to $370 billion. So it's quite a big chunk. It's an unusual year, but it's quite a big chunk. So should we also be thinking about inflationary or monetary policy implications of climate and natural disasters for the US economy?
I don't think that's appropriate for the central bank. I think that look, independence of the central bank is, I think, of critical and important. It's important the central bank make policy for the mandates that Congress assigned us, right? Stable prices, maximum employment. We should not be making monetary policy for political purposes. And if we start making monetary policy for political purposes, we will lose our right to independence. And so I think it's really, really important for us not to touch issues like that. If there's something happening,
but if it becomes inflationary, would you then think it would part of your mandate or no? So if climate shocks or weather shocks would push up prices in the US economy?
Well, if there's something that would make you think that they would push up the rate of inflation on a sustainable basis, then there's some, you respond to the rate of inflation on a sustainable basis. If there's some sort of one-off shock that moves the price level once, but then it's not going to turn into persistent inflation, then you wouldn't. But
Roger is
nodding. A variety of shocks. Yeah.
Roger is nodding very hard.
I agree strongly with that last point, right? The theory of the case has got to be, is this a supply shock that perturbs the system and then returns to normal, or is there something perpetual about it? And that's impossible to know. I strongly agree with the governor's strong admonition that independent central banks really do matter, and the best way to maintain independence is to follow the congressional mandate, which is low and moderate inflation and so-called full employment. What I was thinking as I was listening to the governor speak is he's outlined a very clear view of why the Fed should be reducing rates. What I find very interesting is a lot of his colleagues, as I read what they're saying, have put the weight less on the possibility of disinflation in the housing market or declining inflation in the housing market, and much more on this labor market question. And I think, and their argument is the labor market appears to be softening, but at the same time, the one metric that we follow, well, when it becomes public again, that we follow is the unemployment rate, which actually hasn't moved that much. And so I think the Fed has an intellectual challenge here, which is, if the governor is right that what's going on in the labor market is just supply and demand are both adjusting, and we have a low growth, low hire, low fire labor market, it's not clear to me that a lower rate is going to help fix that, because supply and demand aren't out of balance. And I think the Fed is struggling through just that question of, for those who want to cut rates because of labor market weakness, they've got to be quite clear that there's a supply and demand imbalance, and not simply the entire labor market has come down to a much lower level of growth that still implies a stable market. And I think they're struggling. Some folks, I think, are struggling with that. The governor's got a clear view about the housing market. The Fed will decide if they agree. His colleagues will decide if they agree with him on that view. But it's a very interesting dilemma they face, that the argument for cutting rates is not the governor's argument. It's one about this labor market thing, which is, let's call it ambiguous at best. The flip side is the inflation measurement, which is where he's going, which is, inflation clearly is going to come in lower than we currently forecast. And, time will tell if the theory of the case is right. Let's all hope that inflation comes down much closer to the target. Let's all hope that the labor market is cooling in a healthy way because of changes in immigration, and then we'll see. But it's a very interesting time. Folks in this room are very lucky, if you follow central bank the way I do, to see, the kind of very public discussion / debate going on with a lot of intellectual content, as we just heard from the government.
And if I can just respond to the argument that you just laid out, I mean, I guess sort of to match what I'm saying, I think, to what you just said, is that I view elevated measured inflation as largely being an artifact of the statistical measurement process. And to keep policy so tight in response to an artifact of the statistical measurement process, rather than any actual supply-demand imbalances in the economy, will then create the labor market weakness that we were tasked with avoiding. So I think it's important to sort of think about what is actually going on in inflation, rather than sort of just, like the truth is that an inflation measurement is a complicated subject, and it's a sausage. And Moses didn't come down from Sinai with the right way of doing it. And we have to think very hard about what is actually happening, and do the data actually mean what we think that they mean? And if the data indicate high inflation because rents went up in 2022 or the stock market went up, then that to me is not something that we should respond to. And so I think it's really important to be thinking whether the data tell us what we think that they tell us, as opposed to just taking them at face value and accepting them as some arbiter of higher truth that we can't really think about in terms of trying to identify supply-demand balances.
No, I'm expecting the deep intellectual. Believe when I say I respect the deep intellectual thought that you're bringing to this topic, because that is what central banks are supposed to do. I do want to stop on the image of the 11th and 12th commandment. Thou shalt neither have inflation above 2%, nor shall thou have unemployment low above 4%.
Where is this 2% from anyway? But let's talk about that later. Let's talk about that later.
We know where it came from. It came from New Zealand, and they sort of
they made it up. Anyways, I'm going to open up for questions. So what we're going to do is maybe they're just too many. So we're going to group. Do you mind if we group them in three? Take three questions at a time, or do you prefer to do one? You prefer to do
terrible short-term memory, so you may have to respond. You may have to remind me what each question was, but sure.
No, I also have a terrible short-term memory, so let's do one at a time. And can you do me a huge favor if you just don't mind saying your name and favorite color, not favorite color, where if you're an MBA student, if you're faculty, just very briefly, and your question super briefly, because I want to get through about 10 questions. Okay, cool. Yeah.
Hi, my name is Manmeet, and I'm on the Master in Finance program here at Judge. And my question is around Fed communication with the public. And despite the fact that communication streams have grown rapidly over the past 20 years, it's almost as if the desire for data has outstripped that. So looking forward, what do you think the Fed could do better to improve communication with the public?
Have you watched Steve talk on the news? No. Anyways, how would you improve? Maybe you can take that. How would you improve communication?
So I mean, look, I'm a big believer in transparency, and so I've tried to be very transparent with my thinking, and I think it's important because I do have an out of consensus view, which I think is healthy. I think that it helps. I think that having a wide variety of views helps avoid groupthink, and I think that's really important. And I'm very happy to contribute to that. But I do think, given that the case, it's very important to be fully transparent with why I think what I think, and lay things out, as well as indicate where, as I was saying before, if I'm going to be wrong, where do I see the risks. And so I think in general, transparency is a good thing. It requires as well admitting fallibility. I admitted that I might be wrong, which is something that I think that we need to do. We need to sort of be more honest and humble about what the limits of what economists can know. But I think that those are all sort of fair game.
Could I speak to this? I think I agree with what the governor said in terms of being honest, showing the debate, bringing that intellectual level. I think the market needs to understand what the Fed is doing, because I personally get frustrated when the dot plots show a slight majority in favor of 1 or 2 cuts, and the press says, oh, they promised 2 cuts, and journalists say, oh, they promised 2. The Fed doesn't promise these things. It's all very contingent, and I think the market needs to understand that. And so, I applaud. I was involved with transparency. It's gone further and further. I applaud the things that it's done, but I think the listening base has got to be more nuanced about what the Fed is actually saying and not saying. Second thing I think they need to think about, because it does cause so much, I think, confusion, is how to explain, the so-called dot plots, the summary of economic projections, as they're called. They come out 4 times a year, I guess. And if my observation is the chair has to explain what this is and what it's not. It's not a forecast, it's this and that. And even with all his best efforts to explain what it is and isn't, the market goes back to, oh, they agreed on something. And I'm most frustrated when there's clearly a strong disagreement, as there was in the most recent dot plots. And the market seems not to be coherent about recognizing there's disagreement. So I think what the Fed is doing is very good. I think what the government is doing in terms of transparency is very good. But my plea is for 2 things: clarity about what the dot plots mean, and secondly, for market participants and journalists to not paint the Fed into a predictive model when they clearly are not making predictions.
How would you advise us to change the dot plots, if at all?
I think first question is, should you actually continue to do it?
Don't take
Because
more data away, Roger.
no, it's not clear, partially because what these are is each member lays out against their assessment of the future is likely to be what they think the ideal path of policy should be. So that means 3 things are happening: 19 separate points of view, assumptions that aren't fully disclosed about somewhat disclosed about what they think the future is going to be, and consequently this range of potential policy outcomes. There's nothing wrong with that. We just have to keep reinforcing it. This is not a prediction. We don't know what everyone is assuming. So Governor Miran has been clear about what he assumes on inflation. Not everybody has been that clear. And that's the basis. And so it's 2 conditional statements: if this, if that, then the other. And it's 19 of those conditional statements. That's a complex thing for folks to take on board. And the governor's in the room. I have not been privy to actual conversations in real time for quite a while. I'm not sure the degree to which the dot plots become part of the conversation, even so much as something that they report on. So I just really would figure out, can we be more clear about it? And if not, then we're stuck in this place where we're continuing to put out something that is at best ambiguous. And what I worry about is it's slightly misleading, not because the Fed is intending to mislead, but because the public, the journalists, and the markets want to read more certainty in it than exactly.
So it's a task for our students here. They'll do individual projects equivalent to a master's thesis, where they could maybe explore this and come back with some tips.
That'd be great.
Yeah, I'm going Constantine over there.
About central bank independence in the United States, following threats to fire Jay Powell on the failed attempt to fire Governor Lisa Cook, which was blocked by courts. So my question is twofold. 1, are there concerns about central bank independence? And 2, if so, what steps need to be taken to preserve the independence of the Federal Reserve?
Well, I think it's a bit funny coming from a former finance minister, but look, none of that is my purview. I don't make personnel decisions, so you should direct that question to someone who does. I do think central bank independence is really important for the operation of monetary policies, as I said before. And I think the best way to preserve central bank independence is to convince the public that we are strictly and ardently and aggressively non-political and are not involved in issues that are outside of our terrain, whether it's climate, or sort of social politics, hot button social politics issues that people from central banks, sort of the Federal Reserve included, have been involved in publicly in their role as Fed officials in the past have been involved in. We have to stick to our knitting. The only way that we will be able to maintain our independence as an institution is by being perceived as a fair and neutral arbiter of monetary policy, not being involved in other issues.
So I'd agree with that completely. I remind people that you cannot take central bank independence for granted. The Fed itself was not formally independent until 1951. Their role was to support the U.S. government in borrowing to pay for the expenditures called for in the Second World War, keeping interest rates relatively low. There was quite a bit of tension around that 51 Accord. The president had to bring everyone into the Oval Office, and he did something really clever, which was the person who negotiated the accord from the standpoint of the Treasury, William McChesney Martin. He then appointed to be the chairman of the Fed. So basically, you cooked up this stew. Now you have to eat it, so to speak. So the only thing I'd add, I agree with everything the governor had to say, but I would just say it was not a foregone conclusion that we'll have. I think for sure we'll have an independent central bank in the United States for lots of obvious reasons. But if you think about the history of it, it has not always been the case, and consequently, I think very important to be quite mindful when threats start to arise on the horizon.
I think also one of the things you mentioned before was you need a strong independence central bank to fight against any potential de-dollarization as well. So if the central bank isn't independent, then obviously that could be a threat towards the use of the dollar. And the Bank of England wasn't independent until 1997. So Fed is doing pretty well. Should I jump there? Right there, yeah. The catch box.
My name is Rashwin. I'm from the Master in Finance cohort. I wanted to ask you, actually, you spoke about stablecoins earlier, but what are your personal views on, or rather the Fed's views on CBDCs and the potential, or could there be any possibilities on the Fed issuing central bank digital currencies in the future as a whole, or in general? What are your views on that, perhaps?
Sure. So first of all, from an institutional perspective, it's not something that we're working on. Personally, speaking to my views as to whether it's a good idea or not, I'm inclined to sort of think that privacy and rights to engage in commerce and transactions without sort of undue amounts of oversight or interference from the government are really important. And when we think about what happened in the last few years with reputational risk in the banking system and the debanking scandals that have occurred, where regulators decided they didn't like this or that industry or this or that person, and they sort of tapped on the shoulder of the banks that they were regulating and said, it would really be bad for your reputational risk and the amount of capital that you have to hold if you should be engaged in doing business with this firm, industry, person, whatever. And as a result, you saw the banking system start to withdraw its services, whether credit loans or basic banking deposit services or whatever, from various industries and people in the economy. And that was the case of overzealous and capricious regulators. And if that can happen in the bank regulatory system, I would be terrified of what would happen if a CBDC existed and you had a similar case of capricious regulators in the future. And so, from a civil liberties perspective, I'm not so enthusiastic about the idea. But that's just my own personal opinion. That's not a view of the institution. The only thing from the institution is that no, we're not working on it.
I mean, you've taken the mic, so you might as well.
Yeah, hi, I'm Dominic Caddick from the New Economics Foundation, just visiting, but was previously at Cambridge in 2020. I wanted to ask about the Fed's balance sheet at the moment. So lots of people might be aware that there's a big deferred asset on the Fed's balance sheet of about 0.8% of US GDP. That is accumulation of the losses it's made on its quantitative easing portfolio. And it's sort of brought a lot of attraction to monetary policy implementation from politicians across the world. So Ted Cruz is called to stop paying interest on reserves to reduce that loss. You have it in the UK as well with the Reform Party and the Greens. And I just wondered, what do you think about those sort of proposals? And do you see a role for central banks using their balance sheets more proactively in the future to reduce those losses, to be more profitable, or even make losses for specific purposes?
Yeah, so So those losses exist, in part because of aggressive use of the balance sheet for economic purposes, and I'm fully, bought into the idea that the balance sheet is a tool to use for traditional monetary policy purposes of achieving the dual mandate assigned to us by the Congress, but only when you really need it. And I think part of the problem is that maybe it had been overused in the past, which led to the buying at prices that sort of ultimately proved to give rise to those losses. So I'm not in favor of taking away those abilities, but I also am in favor of using them more judiciously than perhaps they've been used in the past. I don't think that in the current monetary policy implementation framework, in the current bank regulatory system that we have, where we sort of force banks to hold reserves, that you really can take away interest on reserve balances. I think that if you want to think about reducing the outlays on interest on reserve balances, which is absolutely something worth thinking about and discussing, you have to, it's sort of downstream of the issue of the bank regulatory framework. And we first have to think about how we're going to improve the bank regulatory framework in a way that would enable the balance sheet of the institution to be smaller, and thereby allow you to have smaller IORB remittances. Thinking about tackling IORB before you tackle the regulatory system is very much putting the cart in front of the horse.
Maybe can we go there?
So you want to say
Yeah, you want to chuck the, yeah,
please
go for it. You need to throw it. It's a catch box. You can throw it to me and you can throw it there. Oh goodness. Oh, well done.
Well done.
Yeah, bravo.
Okay.
Yeah. Speak loudly into it. Yeah.
My name is Charmaine. I'm a Master of Finance student. My question is, what are your views on the long-term trajectory of the neutral rate, given multiple developments and factors that are playing out, including AI adoption and also aging demographics, some of which may have offsetting impact on the estimates?
Yeah, sure. So I've talked a fair amount about the neutral rate in recent months. I would say, sort of where I would have been on the neutral rate last year was, I would say, at the top end of the range of everyone else on the FOMC, and where I'm on the neutral rate this year is at the bottom end of the range and then of the neutral rate on the FOMC. And in both cases, I don't think I'm, sort of I'm not outside of other people's views. There are other people with the same view of where it was last year and with the same view where it was this year. Where I'm a bit out of consensus is on how fast it's moved. And part of the reason why I think it's moved so fast is, as I said before, we've had some shocks hit the US economy that are just gargantuan in size. And normally we think of the neutral rate moving glacially, very slowly, because the drivers of it move very slowly. And so I've talked a lot about population. Fertility rates, population growth rates normally change very, very slowly, with changing medical technology or cultural trends. And if those change very slowly, then the neutral rate would also move very slowly. And so it's normal to think of it as moving, extraordinarily slowly, and therefore you can, as people say, know it by its works. You can observe in the economy whether things seem like the economy is reacting based on a moving neutral rate as a result. And my argument is that, as I said before, we had 30 years worth of population growth shocks in 3 years in both directions. And so if that's the case, then it's only natural to me that the neutral rate will move more quickly than it previously had been. So where I am a bit out of consensus from my colleagues is not on where the neutral rate was last year or this year. It's on that I went from the top end of the range to the bottom end of the range in a year type of thing. That's a bit out of consensus, but I think there's good reasons for having that view. I think that there are a lot of long-term trends that have been pushing it down over time. Things like decreased population growth, things like aging, which is a result of that. I think those forces will still be in play for a while. It's possible that artificial intelligence creates a sustainable productivity growth boom. I find it difficult to quantify that. I think that economists ought to be humble about many things, and we are not good futurists. And so it could be that AI powers some enormous, spectacular productivity growth boom that would lead you to immensely mark up your estimation of where the neutral rate is. I don't think I know how to put numbers on that, and I think that most, and I don't know that anybody else does either. And I think that if somebody did show me numbers, it would just make me maybe think a little bit less of them. I think it's challenging. It's challenging. So it's quite possible. I embedded some potential improvements in productivity growth from AI in my estimate of neutral before the shocks of this year brought neutral down, which is part of why I would have been at the high end of the range last year, right? Those are still embedded in my thinking for neutral. In my thinking for neutral in terms of after the policy shocks of this year. However, do I have a lot of confidence in those numbers? Absolutely not. It's somewhat marked up, but I think that sort of guesses about what AI does to long-term productivity growth in the United States, I think are speculative.
So can I comment on this one and also the earlier one? So I was on the board when the last time that we had a supply shock driven by technology, and it really divided the board. Chairman Greenspan was famously right, as some folks have admitted publicly, in observing that the last supply shock that we had that came from technology allowed us to imagine that the neutral rate might be lower. There are a bunch of people around the table at that point who thought it would actually increase the neutral rate. And Alan, not being a futurist, but being a great analyst of data, convinced his colleagues on the board that they should keep rates relatively low when a number of folks wanted to raise rates. The reason I raise it is there's a real intellectual conundrum around whether or not a technology-driven supply shock either raises or lowers the neutral rate. One argument would be it increases the return on capital, should therefore drive up more demand, higher return on capital, et cetera, should make interest rates higher. The other is that it really drives an economy that is much more productive, allows for the kind of imbalances that the Fed has to worry about to become less of a problem. So you can run the economy, quote, hot, and you still don't get inflation. So the first thing that every central bank has to figure out is what's the intellectual construct that you bring to this question of a supply shock of the type that's driven by technology, particularly one that moves more quickly. And I've observed in my, I don't know, decades of talking to, being in and around central bankers, that there is actually a struggle intellectually on how to think about a technology-driven supply shock. Secondly, I strongly agree with the governor that there are some longer-term forces, think about demographics, that we think should have an effort or an impact of driving the neutral rate down. What's very interesting about that, though, and it goes, it's the question of how do older people actually behave. And right now we have a population of very, very old people who are not, saving, who are continuing to invest, et cetera. And so if you think about the intellectual construct that says an older population should be one that sort of a society is less productive, et cetera, and lower rates should follow, that may or may not be true, right? The argument that says that is true is take a look at the Japanese situation. Aging population, et cetera, and looks like they're maintaining a very stable society with a very, very low rate because they have this perpetual disinflation. But that was a result of a not aging population, but it was also the result of a dramatic financial shock, and it was very hard to come out of it. So the point I'm making is the intellectual argument for aging population leaving ipso facto to lower neutral rate also needs to be examined.
And can I add on to that?
You're my guest, please.
So there's something super interesting also, which is what one argument that you sometimes hear made is that declining demographics are inflationary because you have less labor, right? There's less labor supply, and then all else equal, negative labor supply shock would push wages higher and be inflationary, right? But all else is not equal. And as I said before, people consume and work. And so it turns out that in the Japanese experience for a while, the demand side dominated. And so Japanese demographics were deflationary for a long period of time. Now, potentially, they may have turned the corner and may have and the inflation process in Japan seems to have changed. So it could be that it's the one then the other, but what we would learn from that experience is that if that's the case, the first one can last many decades.
It might,
right?
Exactly. So that's why I find this question of neutral rate against both the demographic issue and the technology issue so intellectually fascinating, because it's just not obvious that it works one way or the other. And I think we need to be, I'm with the governor here, central bankers need to be humble about their ability to understand these things. Can I go back to the losses on the Fed's balance sheet? The only thing that matters at the end of the day is credibility. And there's some central banks for which losses would become a major problem. That is not the Fed's problem. Some of you know, most of you probably don't. I was the only governor in Washington on 9/11. That was probably the first time that we actually used the balance sheet as a tool of creating, financial stability. And in fact, the balance sheet was relatively small and it tripled in size over 3 days. I think the issue around the balance sheet is not using it properly, because I think the Fed has worked hard to use it properly. I think there needs to be a framework around when you use it, how to use it, and most importantly, what is your methodology for returning it to whatever you think normal is. And I think to some degree, that's a little bit of a dilemma for any central bank, including the Fed, which is we know we can use, central banks know they can use the tool as another one of their tools. The question is framework, and everybody will have a point of view about it. But I think it's important for central banks to maintain credibility, to talk about how they think about the framework of using the balance sheet, just as they talk about the other things that they're supposed to do. Finally, I would not reduce the number of tools that the Fed has. So interest on reserves is, to me, I'm no longer a central banker, but I'd hate to see that, which is a very, very useful tool in terms of maintaining, call it the Fed one, the target rate where you want it. I think it'd be unwise to move that away.
So I've been told that we need to finish, but I'm going to be cheeky and I'm going to take. Oh, Jennifer's saying no, but I'm gonna take two really quick questions if you don't mind. Is it okay? Because we started late, so I'm sorry, guys. I need to get most out of it. Super quick question, and I want a quick question here. Super quick.
Yeah, so I'm Ido. I'm doing the Masters of Finance. My question is, what incentive structure does the Fed have to being good at its job? You're a government monopoly. You have no competition. You have that. I think the dismissal rate of Fed employees is 1% compared to the private market, which is 15%. What makes me, as a U.S. an American living in the U.S., believe that you guys are doing a good job? Like, what makes a central banker do a good job when he knows he can't get fired and he has no competition?
So as so in the United States, oversight of the Federal Reserve is done by the Congress. I bet that there's probably a lot of people in Congress who would love you to ask them that question.
It's great. That is great.
This is, again, a really important question. So if you think about it, for those who know U.S. history, we had periods when we had a central bank, we had periods when we didn't have a central bank. It turns out the periods that we didn't have a central bank coincided with a phenomenal number of boom bust cycles. The Fed, you should know, was created out of a massive boom bust cycle in 1907. It took them a long time to figure out what the right answer was. And they came back to this notion of let's create this very powerful and independent institution called the Fed. And so, to imagine a world in which, you have dueling central banks or don't have one at all, look back at our history and says, during the history in which we've had a Fed, particularly an independent Fed, I would say for most citizens, the grade has probably been very positive. Now, there have been moments of great pain. Think of Paul Volcker, driving inflation out because there had been mistakes made earlier. And so, it's sort of a funny question of your monopoly. How do you know that you're doing pretty well? And I would argue we have a lot of history in which we didn't have a monopoly of a central bank. And it was, for those folks, pretty painful. And we came to this decision after having had, many years where we didn't have a central bank and we had lots of different currencies floating around, and people in New York didn't trust the currencies from Kansas City and vice versa. So I would argue as an average citizen that, an independent central bank with a monopoly on driving money and with the mandate under Congress has been much better than almost any alternative.
I'm going to go to Bill and then.
So that Bill Janeway, Faculty of Economics. That was a hard question. This is an easy question, I hope. One of the numerous positive developments in economic theory post-2008 and the reconstruction of economics as a discipline has been the introduction of heterogeneity and the liquidation of the rational representative agent. That's an observation. Specifically in macro has been the introduction of heterogeneous agent models that take account, that are by construction can take account of the extraordinary increase in economic inequality in the United States, both in terms of income and in terms of wealth, with a tiny percentage accounting for an enormous share of consumption. To what extent have the Fed's models adapted this new methodology of reading the macroeconomics to incorporate measures of distribution as well as of growth?
Yeah, so that's a great question. I think distribution matters. I think it's also probably a more disputed subject than many people who talk about it would give it credit for in terms of just exactly how much the income distribution has changed over the years. I think there's also maybe an insufficient attention to sort of the after tax and transfer inequality versus pre-tax and transfer inequality. It's very different stories, and even more so once you sort of start thinking about compensation as well, because the cost of healthcare grew so much over the course of many decades in the United States that compensation inequality actually I think grew less. But in any case, I agree there's a lot of exciting and interesting work happening in that area. I think the theories are sort of still are still developing. I don't think that the Fed has sort of thrown out all of its old models to embrace the new models. I think we're sort of interested to sort of see to what extent these models give us useful and new insights that would lead us to sort of want to change some of the models that we have. But I think generally it's something that I'm interested in watching and watching and waiting to develop. I'm certainly not interested in throwing at everything I think I knew yesterday to sort of put these models, operationalize them now. I think also very often, there's a sort of a map versus a territory issue, that the map and the territory are different. And models to me are helpful for illustrating channels, right? They help you think how A can cause B, and how A can interact with B. But it's a mistake to assume that the models are more real than the world we live in. And models help me understand the world. They're not the world. And I think that the mistake that I think a lot of people make is that you may need a different model for different circumstances. And in one type of environment, you need one kind of model. In another type of environment, you need another kind of model. And I think, you pull out the right jacket for the weather outside. You open the window, you see what the weather is, and you pull the right jacket out of the closet. And I think the art of sort of being a good economist, whether you're in industry or making policy, is knowing how to first identify what the weather is, and then two, pick out the right jacket for the weather. And it's the people who want to wear the same outfit in August, the same jacket in August and January, that get into trouble because you need different jackets for different weather. And I'm excited to have a new jacket in the closet. I'm excited to have a new outfit. That's wonderful, right? But I'm not ready to wear that jacket all year. I want to sort of see what it can do, and I want to learn from it as it develops.
Can
How are your jackets, Roger?
I,
How are your jackets?
well, I spent a lot of time in Cambridge, and I find that often in August I wear the same thing I wear in July. The same thing in January because January and February because it's cold and rainy and a little damp.
Then I accept present company from all of my.
No.
It's just a
No, look, obviously the comment is but spot on. I would have argued that in some ways the Fed's models, as I recall them, have already taken into consideration a variety of things. And the reason that income inequality matters, it's all about the marginal propensity to consume, right? And so, and it goes to what that means from a macro standpoint. And so when one thinks about periods such as the current one, when equity valuations are very, very high, when housing valuations are very, very high, how does that play through the Fed's models? My observation is they've sort of thought through, okay, what's the marginal propensity to consume for that class of people? How much wealth do they have, or what does that mean about growth? And so, I agree with everything the governor had to say about being careful. I would also argue in some ways, the structure of the U.S. economy plays in through the questions of what are the sources of savings and consumption, which is why people think about things like how tight are our financial conditions, X, whatever the Fed's policies are. And often I found it feeds into this whole other question of, well, why aren't you targeting, asset prices? I don't think they should. But the reason people ask the question, I think, ultimately goes to this whole question of, will there be massive consumption as well as will there be bubbles out of these things? The final point, which I think may have been implied in your question, I want to be clear, my view, and the government will speak for himself, I don't think central banks should be held responsible for things that they can't control. I'm not sure I hope that's not where, it doesn't seem like that's where you're going. And so, let's stay focused, as the governor said, on the mandate given, and let's think about the structure of the economy insofar as it plays into the ability to manage the supply and demand that drive both growth and inflation.
Brilliant. Thank you. Actually, can I ask you one last question? And so I have a colleague, Danny Raff, who always asks me outrageous questions. So I'm going to ask you one, which is, if you think about 10 years, if you think 10 years into the future, and if you could make an outrageous prediction, what would that be? Roger.
It goes back to this AI question. And, I don't believe the most outrageous examples of what we're likely to see. But from my seat on boards and other things, I actually think there's something real about AI. What the productivity boom is going to be, how big it's going to be, I don't know. But I think when we come back into this room 10 years from now, which I intend to do, most of you will probably not be here. Bill will be here. I think we will actually see a world that is in the process of adapting to this whole new world of AI, which I hope will be in some ways really positive. And obviously, we know that there'll be some transition costs as well. That's not an outrageous projection, but it's really, and let's think about this AI question.
I thought the outrageous thing is say we will all come back to this room.
Well,
So with AI, we will be all anyway.
Not outrageous for me to plan to be here in 10 years, and the rest of you will figure out for yourselves.
Thank you, Roger. Steve.
I mean, I wish I had a good answer for you. I have enough trouble predicting 10 months out, let alone 10 years.
Fantastic, fantastic.
You're pretty clear in the 10-month prediction.
No, I know, but no, I mean, I have a prediction, but it's a forecast and it might be wrong.
Fantastic.
And the wrongness of the forecast will only grow as you go out over time, right?
That's
so oh, yeah, nobody wants that. There's no single person.
We'll come back to this. So just to say, those of you who ask questions, we want to just put your hands up. I don't know if you, Roger, Steve, you want to pick any questions or
I'm not going to do
winners?
Please.
No, I think the balance sheet one got us talking, and maybe the independence one got perfect. So if you come up, you get a book. Just there remains to say, I apologize. There were about a dozen or so questions out there. I don't know how many they were online. Thank you so much, guys, for joining us. From Formula One to the Olympics to the Fed. Thank you.